if the Chinese government crackdown is causing so much pain for its own companies, why are they doing it? Why are we seeing such an aggressive tone? Joining me now is Derek Scissors. He's senior fellow at the American Enterprise Institute. Derek, it's great to have you. And to begin with, you distinguish between what they're doing on the tech side and on the education side here. So explain that.
Well, I would actually distinguish tech from almost everything else. Education is an example of something we see from the Chinese all the time. This sector is expanding too quickly. They're chasing money too quickly, too much, according to the government, of course. We have some complaints from consumers. Everybody calm down. We're going to go through a little rectification campaign. And then, you'll be allowed to go back to normal in 6 months or a year. That's very normal for China. It mostly happens in property. There's certainly risk to the stocks, but the sector should be calmer if you look forward a year. Tech is different because it's really about a sea change. The Chinese have said, we need to control the data. All of you need to fall in line. We love tech. We can do without the tutoring sector. It lives, it dies. We don't care. Tech, there's going to be a booming tech sector in China, but under our rules. So they're happening at the same time. People are putting them together. That's totally understandable. But the projection for education is more like a return to normal in a year. And tech is going to thrive, but you better fall in line.
What do you make of the timing of all this? This morning as well, I think Didi got a downgrade on concerns about Chinese regulation and, they're running afoul of the government. We've talked at length about how they IPO'd on the day of the Chinese Communist Party anniversary. And in retrospect, that looks like a very bad idea. And they had been warned. But it seems like since that date, and maybe we should expand the time horizon back to when Jack Ma gave that speech last fall and sort of initially raised the ire of the Chinese Communist Party. What sequence of events here is playing out? What's the catalyst? Where is it going? Or are we just lumping these all together because they're happening all at once and there's not actually any connection?
I do think there's a connection within tech, and I think you hit two of the events. The Chinese tried to warn everyone by delaying the Ant IPO because, in part because Xi Jinping was mad at Jack Ma. They discover, what they see as problems and who's controlling the data rather. If you're going to list overseas and make a lot of money, maybe you'll start following their rules instead of our rules. And somehow Didi doesn't get the message or is so eager for its IPO it doesn't listen. And so they had to send another message. And there is a risk, for sure, of yet another message. There may be another company targeted if they're not understanding that you will follow our data rules. I don't care how much money you're making overseas or you're getting from foreign investors. So I think the Jack Ma event, the Didi event, those are connected. And people who are interested in the Chinese tech sector, they have good reasons, but they shouldn't be surprised if there's a third crackdown like these two.
Probably the biggest Chinese tech name at this point for U.S. investors is Alibaba. What are your thoughts about that? The risks that they're exposed to now, the growth prospects, like you said, if in the long run it's definitely in the Chinese interest to have these tech behemoths, they would, again, seem to be one of the most notable cases.
Yeah, there's too much money in Alibaba. I don't see that much downside risk. There's too much money, foreign money in Alibaba for the Chinese want to cut that conduit off. That money benefits the entire Chinese economy. It allows Alibaba to expand overseas, which is a strategic goal of the Chinese government. But at the same time, they want to keep Alibaba from becoming a threat to their financial system, from drawing savings away from state banks and so on. So, the downside risk for Alibaba, I think, is somewhat limited, but so is the upside gain because regulators don't want Alibaba to be that large and that profitable. At some point, you could see pressure for a split, divide the company up, where both companies look pretty good, but they don't have the same size and reach. I think that's where Alibaba is. It's too big to fail, but in China, you can also be too big to succeed.
Does that mean some of these Chinese tech names in particular are becoming utilities? In other words, trading almost like bonds? I know that seems insane to say after the past 12 months, but going forward, if the downside and upside is capped, if they're effectively extensions of the state, then they have both monopoly protection, but also not that much downside.
Right. That's going to be part of the sector. I think that's well put for what part of the sector looks like. If you have data the state considers especially valuable, your operations are going to be restricted, and therefore, your upside is going to be limited. And that's really the investor evaluation that has to go on in Chinese tech sector. Are you backed by the state and strategic, and there's a huge Chinese market, great. Do you have data the government's going to control, which is going to mean they're looking over your shoulder, mean foreign regulators are unhappy with your operation in their market because they think you're going to turn the data back to China? That's going to cap your upside. So you have that certainly right for part of the sector. Some of these stocks are not going to be growth stocks. And the key there that we've seen recently is how sensitive is the data that they have rather than their basic commercial prospects.
Activity.
Shepard Smith here. Thanks for watching CNBC on YouTube.